Coming to tools of financial analysis. Students, by now we know that financial statements present a lot of information and lot of data through various parts. Like for example, income statement. Income statement presents a lot of data regarding the profits, the expenses, any kind of outlays or payments that have been made during the year. Then we have position statement. Position statement is balance sheet. It presents information regarding financial position. Financial position. That is, we can say that regarding assets and liabilities. Then besides these statements are accompanied by a lot of other information in regarding to accounts. Like for example, we have director's report. Director's reports convey the opinion of the directors regarding the performance of the business. Then we have auditor's report. That is what auditors think. Then we have schedules and workings. How these accounts have been prepared. What are the additional information that have been used for their calculations but are not shown in these statements. Then we have cash flow, we have funds flow, and other ancillary information is also provided along with these statements. Most of these statements are useless for any person who is actually desirous of using this information unless and until he knows or he has means to analyze them. So here comes the importance of financial analysis. What do we understand by financial analysis? Financial analysis refers to use of various statistical or accounting methods to derive useful and productive information out of the given financial statements. I'll repeat that once again. It implies use of statistical and accounting methods to derive meaningful results out of given financial statements. Now, coming to tools for financial analysis, what are those tools which actually help us to gather such information? These tools include statistical and accounting methods. Like simple tools can be in terms of percentages. Now students, percentages means what? We all know we need to calculate relative changes of various figures over various years or various accounting periods. We can say that the cost has increased by a certain percentage or the profit has increased or decreased by a certain percentage. That means we have compared this profit over with the relative profits of the previous year. Then this is a statistical tool. Then we can have accounting tools like ratios, or we call it as ratio analysis. Then we can have cash flow statements. Then we can have funds flow statement. Then we can use what we call as comparative statements and common size statements. These are all a mix of various accounting and statistical methods that are used to derive out useful information from the accounts. So students, in this chapter particularly, we are going to learn about how financial analysis is done using comparative and common size statements.